What have you seen with the levels? People were saying, OK, if it falls below 40,000, that's a concern. If it falls below 35,000, that's a concern. Where are the real lines?
It's definitely a pivotal week for Bitcoin and really the major indices on the equity front as well. The volatility has been real, as you would imagine. I mean, it's really been wild. You can see it in the volatility index or the VIX spiking this week or the past 2 weeks or so. And so for Bitcoin, this 50% downdraft has brought it into what I see as key support. This is around 37,400. It's based on something called the cloud model, and it's a very popular technical model for all currencies, including cryptocurrencies. This level in my work defines the long-term uptrend. So a breach of it, that's decisive. And for me, that means a couple of weekly closes below. We got one last week, so that leaves a breakdown pending confirmation this Friday. That would effectively reverse the long-term uptrend. At the same time, we have a very significant loss of long-term momentum. You can see that in something called the monthly MACD indicator, another very popular tool that has been positive up until this month for Bitcoin since June of 2020. And of course, Bitcoin then was below 10,000. So it's a very significant shift. There are a lot of indications, broadly speaking, for Bitcoin and other risk assets that we should see more of a near-term bounce. And that could certainly help it avoid a breakdown. But it's really hard to picture a market in which equities are trending lower and Bitcoin is doing well.
What happens if Bitcoin does close this week above 37,400, that line that you just suggested is so important?
It essentially preserves the long-term uptrend. So we've had a bearish intermediate-term bias within the context of this long-term uptrend. It does preserve it. It doesn't minimize the loss of long-term momentum. And that's something that's really a problem for the markets in general right now. We're making comparisons to early 2018 as it pertains to the S&P 500 and also the NASDAQ 100, to which now Bitcoin has a much greater correlation with their downdraft year to date as compared to last year. So I think all these risk assets are becoming correlated because of the downdraft in part, where folks in general are penalizing risk assets. So I do see some similarities in the charts. The indicators are showing these downturns that tell us that we might be getting into more of a range-bound environment like we saw in 2018. If you recall, the S&P lost about 12% in that first quarter, rebounded by about 15%, and then we had that nasty downdraft towards year end of about 20%. And at the end of the year, there was really not much progress at all. So it really dictates this intermediate term outlook if you want to beat the benchmarks.
Maybe we should look at some of those charts exactly, because if this is so much more important, this is a bigger issue that we're following. If you look at the S&P 500 and we're looking just for the end of the week, where would you be looking for things to shore up? I mean, yesterday changed all the dynamics for the S&P 500, for the NASDAQ, for so many of the major averages and beyond. Right now, you're looking at the S&P at 4,410. What needs to happen here?
So for the S&P 500 and NASDAQ 100, the damage is really already done from a technical perspective. Those breakdowns, while they're only short-term in nature, they've already been confirmed. The market internal measures, things like breadth, leadership, sentiment, they're all very oversold here and do support a few days of strength. But we're recommending to our subscribers that they use that to reduce exposure, to increase hedges, which we've already been recommending. And that's to avoid this kind of 2018 early year corrective phase, after which we'll be looking for more indications from our intermediate term indicators. So right now we have short-term indications, including for Bitcoin, but what we want to see to signify an end to the corrective phase is something a bit more out of our intermediate term gauges. And unfortunately, even a very strong relief rally for the NASDAQ 100, for one, wouldn't fix the damage that's been done. There's about 3.5% room right now to the 200-day moving average that we could certainly see in terms of a magnitude for the bounce. And I think a lot of people would welcome that as they watch these mega caps just go against them and underperform.
Shepard Smith here. Thanks for watching CNBC on YouTube.